Good afternoon. This is Ken Spencer. I am the President and CEO for HR Service. Welcome to our training webinar today for ACA reporting changes and requirements. It is my pleasure to introduce our presenter today, Holly Young. Holly she is our ACA guru and expert. She has dove into all the ACA requirements over the last several years. Every time there's changes, she's kept up on all of these things. Holly has over 20 years experience in employment law and human resource management. She has a master's degree in master's in leadership. She is also SPHR certified. Holly, I will turn it over to you.
Well, good afternoon, everyone. I just want to mention as we go through the slides, there's a place on this meeting, a chat, that you can submit your questions. So you're all on mute. So if you have questions, go ahead and use that, and we will get to questions at the end. Before I begin, I want to just mention a little disclaimer. I am not an attorney or a CPA, and so this presentation is informational content only. And if you have legal or need tax advice, you should seek advice from an attorney or a tax consultant. So today we're going to go over a few things. We're going to just briefly touch on who has to file. That hasn't changed, but we just want to make sure everybody knows what that looks like. We're going to talk about 2018 due dates because those are a little different than we've had in the past. We're going to talk about some of the changes to reporting, some reporting considerations, which are fairly new for 2017. Some changes to the forms themselves. We're going to talk a little bit about affordability, late filing considerations and penalties, and then finally reporting solution options. So just to briefly go over who has to file. When this all came about, it was applicable large employers, and that is defined by the IRS as employers with 50 or more employees, or an aggregated employer, so an employer that has some control groups with a total of 50 or more employees. But I want to just jump down to the note at the bottom. That is at least 50 full-time employees, including full-time equivalent employees, on an average during the prior year. And that makes the employer an ALE for the next or the current calendar year. And that's when they become subject to the employer shared responsibility provisions and reporting provisions. So if an employer had averaged more than 50 in 2016, they should be making sure they're compliant in 2017, and then they'll be reporting on that on the 2017 year. Employers who are self-funded or level funded, which is mixed funding, and regardless of size, if they still have less than 50 employees, they must report on the 1094 and 1095B forms. If they have 50 or more and they are self-funded and level funded, then they're going to still be doing the C forms, but they're going to be completing part 3 of that C form. And I have pictures of the forms, and I'll touch a little bit more on this a little bit later in the presentation. So what we know so far, and if you've been doing this for a couple years now, there's changes come in at the last minute. And so what we know so far is that employers still must comply with all the ACA requirements, including reporting. Even the executive order signed back in January did not change that. And the other thing that has changed from the past 2 years is the good faith penalty relief no longer applies. So what that was is the first couple years, the IRS had said, hey, we're not going to ding anybody or penalize anybody if the forms were incorrect in some way, as long as the employer can show a good faith effort that they did try to do and put the right information on the form. That good faith effort has not been extended for this year. So Employers want to be especially careful when they report this year to make sure that the information is as correct as possible. So the due dates, another change that happened the previous 2 years is the due dates got extended. That has not happened this year. So kind of in comparison to a year ago, the 1095 forms, which are the forms that need to go to the employees, are either due or postmarked to employees by January 31st of 2018. Last year, that was extended to March 2nd. The IRS submittal of the forms that are going to be mailed, so that would be any employer with 249 or less forms, that needs to be done by February 28th, and that is the same as last year. And then e-filing to the IRS is typically due March 31st. That they've extended that a little bit because that falls on a weekend. So that is actually due on April 2nd this year. And I just want to point out, if you are a company that's going to have 250 or more forms, you are required to do e-filing. There is a request of waiver for that. And if you're interested in that, you can email us and ask about that, and I can get you that form. The form I do want to point out to you, though, is you may be interested in filing for a 30-day extension. And the form for that is called the 8809. It's an IRS publication. And I'm going to talk a little bit more of why you may need that in just a little bit here. So other changes to the reporting, not a lot of changes in the actual instructions. Affordability has changed. So now if you're figuring out the percentage of, what those premiums can cost for employee-only premiums, that's changed from 9.66% from last year to 9.69%. And next year it will be 9.56%. As a consequence, the federal poverty level is changed. So the formula for that is you use the federal poverty level from the prior year, and then you use the current year's affordability. So for 2017, the federal poverty amount is $95.93 a month. So any employee-only coverage, and that was just what the employee would be responsible for. If it was $95.93 or less, the company may be qualified to file under a 1A code, so it's a qualifying offer. But again, I'll talk a little bit more about that. In 2018, we'll use the 2017 FPL, which is $12,060, and this is for most states. There's some higher amounts for Hawaii and Alaska. So next year, the FPL will be $96.08. There were also some notices that came out from the IRS kind of mid-2016, so a little over a year ago, that clarified some of the questions that companies were asking. And many of those became effective for plans starting on January 1, 2017, or plan years starting on that date. So if you're in a non-calendar year, it may not apply to you yet, but it's something to keep in mind. So one clarification was around flex credits. And flex credits generally reduce the cost of coverage unless they can be used to purchase non-health coverage, or can be cashed out or contributed to an HSA. So if an employer offers flex credits that go to pay that premium, and say the premium's $300, the flex credit is $150, now the premium is $150. That's what's going to be reported on your 1095-C form. It's exactly the opposite for the opt-out payments. So unless they're conditioned on providing other coverage, or it's part of a collective bargaining agreement. So what that does is if the employer tells the employee, if you waive our coverage, we'll in turn give you $400 added to your check. Well, now that $400 gets added to the premium. So if your premium is $150, now it's $550, and that's what has to be reported on the 1095-C form. Again, the exception to that is if that employee has coverage maybe on their spouse or their parents' coverage, and then that doesn't apply. Another clarifying point was around wellness program incentives. So what they've come back and said is if you maybe have a $10 reduction in the premium for a biometric test, that does not reduce the premium for ACA reporting. So it doesn't count. And the only exception to that is with a program designed to prevent tobacco use. And then at that point, you report employees at the non-tobacco premium, regardless if they are paying the tobacco premium. They still have the option to quit smoking and therefore at some point be eligible for the non-tobacco premium. Not a lot of changes to the forms. In fact, no changes to the 1095-C form. The only mention, and they've done this now for a couple years, is there's a plan start month box. It is still optional. Last year, they said it was going to be probably mandatory. It is not, but they've said next year it will be mandatory. So we'll just have to wait and see on that one. The 1094-C form, which is basically the cover sheet that goes to the IRS, there are no more transitional reliefs. So there were transitional reliefs offered on line 22. They had box A, B, C, and D, and then they carried those into 2016 for those plans who were non-calendar year plans. So they've removed those this year, so there's no qualifying offer method transition relief on box B, and there is no box C, which is the 4980H transition relief. Subsequently, column E has also been eliminated for the same reason. So here is our 1095-C forms for 2017. As I said, there's really no changes. Down here or up here, the plan start month, you can put something in there if you'd like or not. There's part 1, which is going to have your employee information. And then over here, it's going to have your employer information. Part 2 is where the coding comes into play, and also the amount of the premiums, if applicable. So line 14 is your 1 series code, which is about whether or not there was an offer and what type of offer. So the most common codes that you may see would be 1H would be no offer, and that may be because they weren't employed for that month. The other common code would be 1E, which would be there was a minimum essential coverage, minimum value offered to the employee and their spouse and their dependents. 15 would be the amount of the premium from month to month. If it's the same for all the months, then you would put those codes or amounts in the all 12-month section. And then line 16 is your 2 series codes. So that's going to let the IRS know maybe they didn't get an offer because they weren't employed, which would be a 2A, or they were in a waiting period, which was a 2D, or they actually accepted the offer, which is a 2C. And then the other codes are your affordability codes if the employee happened to waive the coverage. And then finally down here in part 3 is if you had a plan that was self-funded or level funded, you would then need to list the employee if they were covered, and then the months they were covered, and then their spouse and dependents, whoever was covered on the plan as well. The 1094-C, as I said, is really like a cover sheet to the IRS, and they call it a transmittal form. And so the top of the information is going to just be the employer's information with a contact for the IRS. Line 18 is going to be the number of forms that are being submitted with this particular cover sheet. So if you've got multiple locations sending forms in, all of them would put the number of the 1095-C forms, and they would put that number in this box. Now on the 1095-C forms, you just need to copy the front page unless you have more dependents, and then you would need to copy the second page. When it goes to the employee, of course, the first page and the instruction sheet needs to go to the employee. Then it's going to ask on 19, is this an authoritative transmittal? So the IRS wants only one authoritative transmittal, and that means you're going to answer some additional questions that's going to apply to all the locations that might be submitting forms. And so it will give the total number of forms. A lot of times it's one and the same, but not every time. On 21, that would be yes, if you're like part of a control group. So if you have an umbrella company and several EINs underneath that, then that would, you would say yes. Line 22 here is what's changed. So you see here B and C are reserved. They still have a qualifying offer method. The relief that gives you is if you meet that, and that means that you are offering your employees coverage that is less than the federal poverty level, and you're offering coverage to spouse and dependents. And if you are able to check that off, then the relief you get is you don't have to fill in line 15 of the 1095-C form. You get to leave that blank. Over here is the 98% offer method, and if you offer coverage to 98% of your employees and their dependents, you get to check that box, and in turn, kind of going to the next page, the relief you get is you do not have to fill out column B. So it's going to ask, what months did you offer minimum essential coverage? That you'll check, and really honestly, the insurance that I see now, I don't see anything other than minimum essential coverage being offered, which would be health coverage. It wouldn't be like just dental or just vision. It's the health part of the coverage. So you would just check yes, and that has to be at 95%. So keep that in mind. It has to be for 95% or more. And then aggregated group, if you were part of that control group, this is where you would check the boxes for the months that you were part of a group. And then C here is where you would list a total employee count. So that includes all employees, seasonal, temporary, part-time, full-time, everyone. If you are obligated to fill in column B here, that would be full-time employees, not including full-time employees who were in a waiting period. So want to touch, kind of moving along here, want to touch really quickly on affordability. And you'll see here why I'm going to do that. So the IRS says that the safe harbors are optional. An employer may choose to use one or more for employees for any reasonable category, and that as long as it's used on a uniform and consistent basis within that category. However, dropping down here, an affordability safe harbor code cannot be entered for any month that the employer did not offer minimum essential coverage to at least 95% of its full-time employees and their dependents. But if they did, then you can do categories such as salaried versus hourly, managers versus warehouse workers and that sort of thing. So here's your codes for line 16. 2C is of course, the easiest one, and that's if they accept coverage. That's what you would put in line 16. However, if they've waived coverage and the company has it is affordable, offers affordable coverage, then if they've based it on W-2 box 1, that would be a 2F code that they would put in. If it's based on the federal poverty level and they're qualified to use that 1A code in line 14 of the 1095C, then that would be 2G if the employee waived coverage, and then 2H would be rate of pay. Now, I have seen some confusion on the rate of figuring out rate of pay, so I just want to mention that really quickly. Rate of pay, to figure that out, is you take the employee's rate of pay, so let's say $10 an hour, times 130 hours, times 9.69%. So even though that employee might have worked 160, 180 hours that month, that's not the hours that you get to use. You actually use that 130 hours regardless of what they actually worked, which is going to make the premium a little bit higher, so just be cognizant of that. If it's a salary employee, you can use just their monthly rate of pay times the 9.69%. One thing I want to point out that the IRS has said is if they receive an increase during the year, you use the lowest rate of pay that they had during the calendar year. So what's the problem with this? Well, if you're not set up to have data for your W-2 box 1 fairly quickly after the end of the year, and now you have W-2s that have to be postmarked and or distributed by January 31, and this form by January 31, you may not have those figures. And so you may want to go and check your payroll system or your HRIS system to see how quickly you would need, or how quickly you can get that data. Because if that's what you're planning on using, you may not have it in time. And that's where I just would recommend going ahead and filling out that 8809 IRS form and requesting that 30-day extension so you can have those figures to ensure that everything matches once you get that submitted to the IRS. I already mentioned this, but I just want to let you know employers should not count on lack of enforcement by the IRS. A and B penalties still apply, and they've increased a little over the years. So, as I said, things come out very last minute, and this is no exception. So just less than 2 weeks ago, on November 2nd, the IRS updated its employer mandate guidance. So if you go on their website and look at their FAQs, it's kind of towards the bottom, starting like with FAQ number 54. But they're going to be notifying employers here, late 2017, which I would say this is late 2017, regarding penalties that they believe the company owes for 2015. Those notices will be sent via letter called 226J, and you're going to have some handouts and you'll have access to this link, but only with the 226J can penalties be assessed. So there were some mismatched TINs, and there were some letters about from the marketplace asking some questions. Those were not about assessing penalties. This one will be about penalties, and typically the employer will be given 30 days to respond and or contest what the IRS has found and before a liability is assessed. So please keep that in mind. I'm be interested as these letters start coming out, see what happens here. Just to go over penalties, right now the penalty to file for failure to file a correct return is $260 for each return, not to exceed $31,93,000, I think, and then the penalty for a payee statement is also $260. So basically, it's $520 penalty per form. And so if you haven't filed 2015 and 2016, you may want to consider getting caught up, because if it's proved that there was intentional disregard, those penalties can even go higher. There's no cap on what they can penalize companies on. So I want to go ahead and turn it back over to Ken. And if there's any questions, please go ahead and submit those now, and we'll do our best to answer those. And
Great.
Thanks.
Thank you, Holly. We really appreciate your presentation today. And it looks like you did such a great job. So far, we don't have any questions that have come through. I do want to point out one thing, that some of you may have self-funded plans, and you may have less than 50 employees. Anyone who has a self-funded plan has to complete Form 1095B, regardless of the number of employees. So just keep that in mind as well. And then, of course, you're an applicable large employer if you have 50 or more employees, as Holly had mentioned, during the prior year. With that being said, now when we look at the various options, how are you going to get your reports done? You know, many of you are pretty up on the codes and are able to just dive in and complete this on your own, and that's great. And if you have questions, feel free to call us. We can help you with questions. Others may be doing it through your payroll providers, and that's certainly an option, and probably ought to look at that option as well. HR Service has been doing this for 3 years. And so if someone would like help, we actually do a full service option where we'll complete all of their 1095s and their 1094 report. We'll provide the employers with a copy of the 1095s to distribute out to their full-time employees. And then we'll submit in the 1094 along with copies of the 1095 on their behalf. There are some options where, if you would like us to, we will actually send out the forms to your participants, or there's also an optional where we'll do the e-file for you as well. So we have all of those options that are available. But our goal is to just make this easy for you. So anyone that works with us, you can see here the rates for this. And in fact, as a participant in our meeting today, I'll send you a copy of a handout that can go out. I also will send you a copy that will include the details of the rates. But the rates are based off of the size of the group. So as you can see on here, $350 for groups with 25 or fewer. So that would be someone that has a self-funded plan doing the B forms. Others would start at around the $1,600, most being around the $2,000 range, for us to complete it. And then some additional costs might apply based on if you have multiple EINs, if you have banded premiums, if you have multiple groups, or if you have us do the e-filing, or if we're mailing out the 1095s to employees on your behalf. But we will email you those details, and we'll also email you a copy of today's presentation. It has been recorded, so we'll send that to you as well. So if there's others at your office that would like to see that, then feel free to pass that on. You can reach us. Holly, if you'll advance to the last screen here, you can reach us if you have any questions, or if you would like to get started on having us help you with the full service. Call us at 855-447-3375 extension 1, or solutions@hrserviceinc.com. You can send questions directly to Holly at hrserviceinc.com. And then all we need to save to set someone up on the service and save their time for them to make sure that it's done on time is just that signed agreement, which we will provide you, and then we're asking for half down. And Holly, we do have a couple of questions that have come in. So I'm going to go over to those here for just a moment. It says, are we able to get copies of the slides of this presentation? Yes, we will make that available upon request. So I won't send them to everyone, but I will send them out to anyone that's requesting that. So Virginia, I will make sure that we get that to you. Another question says, our plan year begins 12/1. What federal poverty level do we use, and what % do we use for calculating affordability for planned years beginning 12/1 2017?
So it's still starting in 2017. So you're going to use that 95-93 from 12/1/17 all the way through 12/1/18, and then you're going to jump up to that the 96. I forgot what the 96 and the change. So, but just think of what your plan year starting 12/1/17. So it's still the 12/17 plan year.
Okay, great. Thank you. Well, thanks everyone for your participation today. Again, let us know if you have questions or if we can help you complete your documents. We'd love to be your resource for that. And with that, happy Thanksgiving and have a nice afternoon.
Thank you, everyone.